Well, hello everyone. Welcome to Trading Covered Calls and Short Puts. I am filling in for Cameron May, who is vacationing in Scotland. So times are tough for some of us coaches here. In any event, I'm hoping he'll post some things on X so we can see what he's up to. In the meantime, today we're going to talk about a strategy called a buy right covered call. And this is where you both buy the stock and sell a covered call at the same time. And some will use this as a strategy to if they think they're buying close to a resistance level. Others might use this as an income generating strategy where they're buying the stock, selling the covered call in the middle of the road, so to speak, with the intention of it being the covered call being run over by the price of the stock and with the intention of being called out, which is kind of counterintuitive to how some people have used covered calls in the past. But that's what we're going to talk about today. So I hope that you're as intrigued by this as I am. I didn't understand this strategy when it was first introduced to me. And, when I looked at the numbers, it became much more interesting. So we're going to look at some example trades. We're going to place a couple of example trades today. And we'll go from there. So if you are not following me on X, I invite you to do so. My handle, Barb Armstrong CS. We also have the privilege of having Mr. John McNichol, who is back. He has spent much of the last 2 years in the reserves on tours of duty. And we are both appreciative of his service for our country and delighted that he is back now, serving us here at Schwab and all of you. And I want to also thank all of you who show up to help bring this class to life. So to Paul and Lawrence and Tatjana and Riceberg. And I never eat here, which just makes me hungry to see that and makes me want lunch. Anyway, glad that you are all here. And just before we kind of get into the thick of things, know that options carry a high level of risk and aren't suitable for all investors. Also know that when we're selling covered calls, those short options can be assigned at any time prior to expiration, regardless of how far they are in the money. But in a paper money account, which is what we're using today and what I encourage you to use for your practice, the covered calls will never be called out early in paper money. And so that's something that we have to take in mind. Also, if we use a stop loss order, and I'll show you how to do that for this strategy today, know that it doesn't guarantee we're going to get out at exactly the price we requested. So that's important to know also. So let's come over to the Thinkorswim platform. We're going to start with looking at the S&P 500. We had a great fall here, right? From February through February 19th, actually through April 7th, the S&P was down over 20%. And it's really come a long way back, hasn't it? And when we look at the NASDAQ, and I really don't talk a lot about the markets overall in these individual webcasts, because at the beginning of the market day, Kevin Horner, 4 days a week does Trader Talks. And he's covering that just beautifully. So he and Brett Crowther had a conversation this morning and looked at the market. So I encourage you to refer to that. Also on Wednesdays, Mike Fairborn does a really great class called Market and Sector Analysis, and he kind of does a deep dive on what's going on in the market. So NASDAQ, kind of a similar pattern. We're seeing both diagonal and horizontal resistance breakouts on this index. We had a bit of an inverted head and shoulders pattern here. Do you guys see that? Where, here's one shoulder, the head, and our other shoulder. And it's now broken out. And this is actually since it broke out, the first down day, and it's down by a smidge. And this red candle that it's bordered in red means it opened lower and it's currently moving higher. It's down by like 1/3%. And so, and that candle's live. So who knows where we'll be at the end of the day. And then when we look at volatility, and this one has been the biggest surprise to me, we're back under 20. Like I had thought that we might end up, staying in that $22 range. We're back at 18, which, when we look at, if I put that on the charts, we're at 1808. And this, that's kind of in the thick of where we've been quite often in the last year. So, we're kind of back in a more normal range for this last year than we have been. So let's come now and talk about this strategy. And we're going to start with Delta. And when we look at Delta, ticker symbol DAL, we see this consolidation pattern. We see, a diagonal resistance breakout, which last week I was kind of jokingly saying it's what all the cool kids are doing, because we've seen, a lot of these diagonal resistance breakouts. And then it's come back up to this previous high and has broken out. And it looks like this 50-ish level, 49.70 level, is in fact acting as a support level. And so if we said, well, I could see Delta continuing to go up, I'm not sure I want to add it to my portfolio long term. Excuse me. I'm just going to have a little drink here. I think of this as a dating strategy. So the idea here is that, we had a recent high here around 53. So could we sell this 53 or 54 strike and get enough premium for it to be worth our while? And the idea being that our expectation is that the stock might continue to go up and go through our strike, and we'd end up either being called out or we might close it out when it got close to being worth its max gain. And would that be worth our while? So we're going to come to the trade tab, and we're going to come out to June 20th and say, well, here we could sell this 52.50 and get paid $2 for it. And you might think, well, 52.50 isn't a whole lot. Like this $2, it's not a ton, but this is a $50 stock. It's at 51.16. So that $2, if we come and we're going to switch this out and we'll make this our calculator. So if we look at this, say $2, call it $2.05, and we divide that by what we're currently paying for the stock, 51.16, that's a 4% return. And then it would have to go up by like $1 and change, $1.30. And so we could maybe make $3. Well, let's see what we'd in fact make. So if we come to buy custom, we're coming to buy covered stock, which is the nomenclature on the Thinkorswim platform. So when we look at this 52.50, what's the most we could make? Well, if we are to be called out, if we were called out, we'd make 52.50 minus what we, paid to get into the trade. That's $49.13. So if I took 52.50 and we subtracted 49.13, we'd make 337. And if you say, okay, well, if I make 337 and I've invested 49.13, what does that come out to? Well, if it was $50, that's almost 7%. So it's probably over, I'm guessing. I'm just, doing that guesstimate. So if I take this 337, which is our potential max gain, and we divide that by what we're paying to get into the trade, 49.13, that's a 6.8 and a half, so round up to 6.9% potential return. Now, how much could we lose? Well, we could lose $4,915, because it could go to zero. I mean, the odds of it going to zero are not high. And if you want to see what the probability of it going down is, like if we turned this to 30 strikes and we looked at the put side, we've got here it's saying the probability of it coming down to $42 a share, which is not even $10 down, is 10%. So the probability of it going to zero isn't high, but how might we protect ourselves to the downside? Well, we might say, we saw support here around this 49.69. What if we put a stop 3% below that? Because we're expecting that to hold as a support level. So if we put our stop at 48.19, then what are we risking? Well, we're risking about $3 a share for the possibility of making about $3 a share. Because this is 49.12. Well, 48.19, we're risking less than $1 a share. And so if we said, well, we'd be, okay with having a $15,000 position, and we're willing to risk, let's just say we had a $500,000 account, we'd actually be willing to have a position that was up to 5% of our account value, then actually we could have a $25,000 position. So we could do 5 of these. And if we're willing to risk up to $2,500, which would be half of 1% of our account, then if we're risking about $100 a contract, then we're certainly under the 2,500. And again, there's no guarantee. Now, how would we put that exit in? Because we don't know if we had to buy back this call exactly what it would be worth. Well, we're going to change our single order to first trigger sequence. And then we're going to come up and right click anywhere on these 2 green lines, create an opposite order and say, hey, if this goes, all right, we're going to make this good till canceled. We're going to make this a market. I don't know why this isn't changing for me. Okay. Here's my conditional order. If delta goes at or below 48.19, I want to exit this position. And then that would both buy back the call and sell the stock. Maybe that was my problem. But till cancel. I want this to be a market order. I don't know why this isn't allowing this to change. I'm going to just try this again. I've only done about first trigger sequence, right click. I've done several of these in the last week, opposite order. It's not letting me change it to a market order, and I don't know why. So we want to change this to a market order. So I'll get with the technical team. I don't usually use this account as my example account. So we'll see. So we'll just put this in and then we'll go in and put in our exit. So we're just going to, we'll put the order in and we'll see if we can do it that way. And my apologies for making this look more confusing than it should be. Oh, and we wanted to do 5 contracts. Confirm and send. And we'll send that in. Okay, so once that fills, we'll go back and see if we can put that exit in. Let's come and look at, all right, so that's in. Come to our monitor tab. You can see I usually have lots of contracts lots of example trades going on. So we're going to create a closing order. Now, I should have been able to do this when we placed the trade, and I don't know why that wouldn't go in. So when we click that disappearing, reappearing sprocket, then this brings up our conditional exit, and we want it to be at 48.19. So there we go. So if at first you don't succeed, you just try again. And I mean, one of the things with Thinkorswim is that there are many ways to do these things. And you know, you always want to read these notes at the bottom. You know, it's saying due to potentially, oh, this says 49.19. We want it to be 48.19. So up comes our conditional order again. We want this to be 48.19. It's one of those days where you can't win for losing. Okay. And this is why it's so important to read these when you put them in. So we want to close this position out, which means buying back the call and selling the stock if delta goes below 48.19. Okay. So, and we're going to send that in. Okay. So that was delta. I thought it would be interesting to look at MicroStrategy. And this is another one. This is a stock that is fairly volatile. Well, what does that mean? It means sometimes that the premiums might be richer. And, you know, we've seen this stock consolidating, but it's breaking out above this recent high over here. So we can see it's breaking out there. And support and resistance is a range, right? And then we had this double bottom pattern down here, and it broke out above that also. And, you know, this was a pretty big, you know, from 233, this is over $100 from 233 to 341. So a technician, when this broke out, might say, well, I'd assume then that this might go up another 100, you know, to 441. And so could we look at this again? You might say, well, I don't know if I want to have this in my portfolio longer term, but I would be okay with, you know, a dating strategy where it's like, we're going to get together for a few weeks, see how it goes. And if it works out well, like maybe we do it again. Okay. So, and for some people, you know, this is a more expensive stock. So, and we have to buy 100 shares. So you might say, well, if I don't have, you know, $40,000 in cash sitting around, then maybe this isn't a good strategy. And you're right. You know, you might have to look for a less expensive stock. So, but let's come to our trade tab and just see what the premiums look like. And, you know, if we come to June 20th, this is a volatility, implied volatility of 80%. I mean, that's extraordinarily high, which means this could go super, super well or really, really badly. And it could go either way pretty quickly also. But if we look at this and say, well, hey, this recent high was at what? 423, 425-ish. So could we sell a covered call here thinking if this continues to go up, this could work out, you know, nicely for us? And once you put your line in, and let's just look at, so we're going to have to add some more strikes. So if we looked at this 425, we have 500 contracts. And here, let's, you know, this, let's customize this. And I've already customized this. It says Barb's Basics with touching. If you don't know how to do that, I don't want this net change in here though. So I'm going to come here to say, I want to customize this. And I don't want this net change in here. So I'm going to remove it. But I may want open interest, and maybe I want volume to see how many contracts have traded today, so we could add that. And then, okay. So now when we look at this 425, 562 contracts on the books, 82 contracts already exchanging hands today. And this is a $2,600 contract. So we'd receive $26 a share. Now it is a $409 stock, but if it went up through 425, how much could we make? So if we look at buy covered stock, well, we'd be getting in for $383.83. So let's just call it 383 to make the math easier for me. The most we can make is 425. So if we say, well, the most we can make is 425 minus 383. Oops. 425 minus 383. We could make no, that's not right. I'm sorry, this is like my nemesis. 425 minus 383. I could do it faster in my head. $42 a share, that's $4,200. But what is that as a percentage of what we're investing? So if I divide that by 383, that's a 10.96, call it 11% potential return. So if we said, okay, well, we're okay with that. We'd be in this trade for a max of 32 days. We could be called out at any time. If we're called out, are we sad? No, we're going to be happy campers because then we've just made our max gain earlier. So being called out or having an option exercised prior to expiration is not always a bad thing. Now, how do we protect ourselves to the downside? Well, we could say, well, we saw this support level here, and yesterday's low was 389.01. If we put a stop 3% below that, 389.01 times 0.97, our stop would be at 377.73, 377.33. So if we come to our trade tab and we say, well, we're paying 383 to get in, if our stop is at 377, that's less than $10 a share. So we're risking about 1,000. So if we're okay with that, we're going to change our first trigger sequence, our single order to first trigger sequence, right click. We'll see if this will work this time. There we go. It's just being temperamental. And then when we bring up our conditional order block, monster, mark, at or below, I keep saying monster. It's MicroStrategy. It's just my brain links that ticker symbol together and comes up with something different. So it's MicroStrategy. This is a tech stock. So if this goes below 377.33, we want out. And we're going to do 100 shares. And this is if we had a $500,000 account, this would be a bigger position at 30 because we're investing how much? 38,000. And so, if you had $1 million account, you might say, I'm fine with that. Or if you're willing to invest a higher percentage, but otherwise you might say this stock is a little too expensive. But we're going to put this in as an example trade. There we go. Okay, now if you'd like this to show up on your chart, and our strike is at 425. If you're watching this, day to day to just see where things are, you can always right click on this, edit it, and then put in here 425 and I know for me, when I type in that it's a buy right covered call, usually my intention is to be called out. And then I say, I want to see that on the right. Okay. So there's our goal, is for it to come up above this line. Okay. Okay. So let me just have a look at the chat. Yeah, Al Riceberg is saying if that works out, that would be a nice weekend at the beach. Yeah, that's not just putting gas in your tank for most of us. Yeah. But this stock has the ability to move very quickly, and we've seen that, right? Like, it's up $10 today. And when we look at the last 14 days, this is what ATR means. On average, this stock has moved about $21. And so having a target of 425 for a stock that is trading at 410 is pretty modest. Mark, thanks for trying to help out with my stickiness on the platform. Yeah, and Michael is saying with the volatility so high, it feels like it always swings through the stop, and that can happen. That absolutely can happen. And so some people might choose not to use the stop because of that, or others. So let's do another example and use an alert instead of a stop. Okay. Let me just look at the others. Mark is saying, if your guide to choosing the strike price is a delta of 80, no, that isn't actually my guide. I'm just looking at where, like, if this were a swing trade, I might have put my target around 425, and I'm kind of looking at the flow of the stock and thinking, if my goal is to be called out, a delta of 80 has a higher probability. When we come back to Monster, though, we see here that we have a 39% probability of this being in the money at expiration, but an 85% probability of it going before that. So, we maybe, if we were up in this example trade, say 2,000, and our max gain on it was over 4,000, we might say, hey, we've done pretty well on this, and we might choose to take the money. Why wouldn't you want to choose the strike with the 16,000 in open interest? Well, we could, because that has more liquidity. There is no doubt. But I've got on a $26 stock a bid-ask spread of 45 cents. So the bid-ask spread is pretty tight. If I choose this one with the 16 contracts, we're going to make more, like on the selling of the call, but not that much more, like maybe $2. But then I can make $5 more if I sell the 425. And that's just a personal decision. I mean, we could place both trades and then just see how it works out. But, 562 contracts, it's not nothing. Frankie is asking if we can look at Schwab. The answer is no. Yep. How important is it? So, Chana, I like this question. How important is it to have high volatility versus low volatility? Well, the higher the volatility, the juicier the premiums. And we can see that here, that these premiums are pretty juicy. Like when we look at something like a Coca-Cola, where the volatility is 19%. And we're looking at, something. Well, I don't know here's our probability of it being 40% in the money and 80% of it coming up and touching at the 72.50. We get 97, like that's just over 1%. Like if I take 98 cents divided by 72.50, so 0.98 divided by 72.50. Like that's I may not have 0.98. I didn't have my, let's just call it $1. $1 divided by 72.50. So that's 1.4%. I'm rounding. Versus MicroStrategy, where, if we look at this strike here with it's a little bit higher. Let's go to 80%. Let's look at the strike that we chose. So 425, and we got paid, let's call it 26 divided by 425. As 6%. So this volatility, it means the premiums are juicier, but it also means that the stock is expected to move. And notice it says plus or minus. The one standard deviation move here in the next 32 days for this stock is almost $80. It's $79. And that's up or down. So it's, again, like that's a pretty significant move, where with Coke, lower volatility. It's a much less expensive stock too, but at 323. Like Meta would be another expensive. Here's a $600 stock. It's even more expensive, but the other stock was 420 something. This is 638, but the volatility at 33%, the expected move is 50, like proportionately much lower. And your return on your, premiums on this, on a Meta, for example, again, let's just round and call this 24 divided by 640, 3%. So there's a pretty wide variation, and that's how volatility impacts it. But I like the way you're thinking. That's a good question. Question everything. Yeah, there's a higher degree of risk, but risk and reward, they're kind of kissing cousins, right? It's the yin and the yang, and you have one that goes with the other. So let's look at a stock in the financial space. So let's look at MasterCard. So when we look at MasterCard, oh geez, this is another. So dang expensive. How about Visa? I think it's a little less. Yeah, like it's not exactly in the cheap seats, but at 369. And again, we had this big bottoming pattern, and it's come up and broken through the previous high. Now, will it stay there? Well, we don't know. But, and this is one of these, like, ooh, it hasn't come back to retest yet, but if we're thinking this might hold, and I wouldn't mind owning Visa, but again, dating strategy, we'll see how it goes. So if we come to the trade tab, this one is considered not very volatile. And so if we look at this and say, okay, well, 368, what if we sold the 375? Like we're getting closer to 1%, but we've got lots of volume traded here. And so if we say, okay, 375, just exactly how much would I make, Barb? Tell me that. That's what I want to know. What's the net? Well, about $12 a share, $11.90 according to this. So if you say, and just allow me the 10-cent window, I'm going to go for the 12 divided by 363. So that's 375 minus 12 is 363. That's still a 3.3% return. Like in 32 days, some might argue that that's not too shabby. So if you go out for the, May 2 weekend, Memorial Weekend, and you say, like, hey, can you believe this woman suggested that this might be an interesting example trade, and I'm only going to make 3% in, 30 days? Like, not worth looking at. Well, it beats a poke in the eye with a sharp stick, and it's $1,200. Like if we come and we look at this, confirm and send, we could make, the most we could make is $1,189. It's like, okay, I have had mouse issues, not with the little mouse running around the house kind of issues, but my um, my mouse on my computer seems to be doing some kind of intermittent, work stoppage program here. So at 363 now, in this one, instead of putting in a stop, we're just going to buy 100 shares of stock, sell our covered call. And then to avoid that potential whipsaw, we're going to say, hey, if we were looking, say, yes, Friday's low was 360.89. And if I multiply that by point, that's around 350. So could we put in an alert here and say, hey, if this goes below 350, you can make it specific, or you can say if it goes like, should we close out the buy right position? You could ask yourself. And this is just a note from you to you, and it'll come to you however you've set it up. So now we have this warning in place, but it's just a warning. It's not a stop loss, so that if it comes down and nicks it, you're not going to get stopped out, which is particularly annoying when it just comes down and then moves back to the upside. Yeah, Riceberg, I like your question, but I actually have this one plugged into my computer, so I don't have battery issues. So I don't know what's going on. Anyway, there's another example trade. Now, if you want to see an example trading plan, I did create one for this strategy, and this is why you want to subscribe to the Trader Talks channel from Schwab Coaching, because if I bring this up here, what you'll see when you first come to this page is Trader Talks. It's whatever is currently being taught or whatever is coming up next. But if you click on playlists and then come down to these trade management mini sessions and click view full playlist. Well, if you're interested in technical analysis, I'm doing all these shorts. They're all like, kind of 2 to 5 minutes long on individual candlestick patterns. But if you scroll down, all these ones in blue are example trading plans. And so you kind of go through, it walks you through some of the things you might want to consider in setting up an example trading plan. And that's under the trade management mini sessions, and it's, called example trading plan buy right covered calls. Okay, and then there's, in the trading a smaller account class, we do a lot of verticals. So I put those in there. So, and I'll continue to add to this. There's one for stock investing also. So just so you know, it's there. Also, if you're thinking, I kind of like this strategy, I'd like to see more classes on it, there is a playlist for this class. And so you can go and check that out as well. Okay. Also, if somebody's saying, this is the first time I've been able to come to a session live. Well, if you're saying, I've never heard of Barb Armstrong, I'd like to see what else she teaches, you can come to schwab.com/coaching and come to live webcasts. And then when you scroll down, you're going to see, then this is the whole month of May. Here's today. So we can see that, up next is Liz Ann live. And then Connie Hill, this is one of only 2 classes a week that isn't available in a recorded fashion. And I'd highly recommend you check out Connie's class at 4 p.m. Eastern as well. But if you wanted to look at a particular coach, you could come and say, hey, let's see what else Barb teaches. So, I do teach every day. Tomorrow is getting started with technical analysis, which like for me is the IT of trading. I wouldn't place a trade without, looking at a chart, which is what technical analysis is. And then this after the close is a brand new class. I'm thinking we may try and retitle that, but it's really for people who don't want to be sitting in front of a screen and looking at the markets all day long. Maybe, they've got a family and a household, and, they get to look at the markets at 8 o'clock at night. And so how could we trade and either generate income or grow our account kind of in a less hands-on kind of fashion? Okay, so I want to come back to this platform. And, in that trade management mini session group, so this is an account that I don't often use. So we only have these 3 trades. But if we wanted to create a group, we have a group called Stocks with Targets, Stocks for Growth, Stocks for Dividends. But we could come up here and we could create a group. And we could call that group Buy Right Covered Calls. So now we have a group called Buy Right Covered Calls, and we can take our positions and move it. And it's pretty easy. Just move to group, the Buy Right Covered Call group. Yep. So, and we can see we have 2 trades that have an exit in place, a stop loss order, and one that has an alert. And we're up a whopping 2150 so far. Woohoo! It's a virtual, like tomorrow we could be down. So, if I get to teach this class again, we'll come and we'll check these out. Okay, so that's a wrap for this one. We placed 3 trades, one on Delta, one on Visa, and one on MicroStrategy. And they all expire June 20th. The goal for each of these is for our calls to be run over and ultimately for us to be called out. So if you wanted to do some additional practice, where else might you look? Well, you could look at a Goldman Sachs. If you wanted a less expensive stock, you could look at Rivian. And again, this is one that has a lot of volatility. Look at that. It's up 59 cents, but it's such an inexpensive stock. Look at that, the size of that candle. We actually put a covered call trade on in another class last week on Tuesday. And I think we did another one on Wednesday. So I guess those will be doing all right. We had them at the $16 strike. So if this stays up, then we would be called out and we would be okay with that. So guys, thank you so much for joining me. If you would hit the like button, it helps move this up in the algorithm so more people can find this content. I want to ask you also to subscribe to this channel if you haven't done that already. Follow Mr. McNichol and I in the Land of X, John McNichol CS and Barb Armstrong CS. And last but not least, have a really awesome rest of your day. Get out there and hug someone you love and stay tuned. There's more great content coming your way. Bye for now.